All right, let's jump right in. Today, we're tackling a really fascinating question that's bubbling up in the world of global finance. The idea of a Mar-a-Lago Accord. Is it possible that a secret deal could be on the table to deliberately weaken the US dollar? Let's dig in. I mean, it sounds like something straight out of a movie plot, doesn't it? A few of the world's most powerful people huddled in a room, making a decision that ripples across the entire globe. So, can a secret meeting actually change the value of the money in your wallet? The short answer? Yes, it absolutely has. And to really get a handle on what might be coming tomorrow, we've got to take a look back at a pretty dramatic moment in financial history. Okay, so let's rewind the clock to 1985. Picture this. New York City, the iconic Plaza Hotel. The big problem at the time was a US dollar that had gotten so incredibly strong, it was starting to seriously mess with global trade. What went down in that hotel became the playbook for basically every major currency deal since. Just look at the wording here. So calm, so diplomatic. But the single sentence was a bombshell. It was the public signal telling financial markets that the 5 biggest economies on Earth, the G5, were on the same page. They were going to work together to push the dollar down. And believe me, the markets listened. Now, this timeline shows you that the Plaza Accord wasn't just some one-off meeting. No, it was a whole process, all carefully managed. They spent months negotiating in secret. Then, after the big announcement, the central banks coordinated their moves for 2 whole years. And get this, when the dollar started falling too fast, they got together again for the Louvre Accord to put on the brakes. The big takeaway here? This was a long game, with a plan for the beginning, the middle, and even the end. And that brings us right back to today. The US dollar is, once again, super strong, and it's squeezing economies all over the world. So that's got analysts asking the big question. Are we about to see history repeat itself? Could a modern version, nicknamed the Mar-a-Lago Accord, be on the horizon? First things first, let's be super clear. Mar-a-Lago Accord is not an official name. It's a nickname, a bit of Wall Street shorthand that analysts and investors are using. It's their way of talking about a potential new, coordinated international deal to bring the dollar back down to earth. So if something like this were actually going to happen, what would it take? Well, analysts have pretty much broken it down into what you could call a recipe. 6 essential ingredients you'd have to get just right to cook up a modern-day accord. Okay, let's walk through this, because every single piece is critical. Number 1, U.S. alignment. You need the White House, the Treasury, and the Fed all singing from the same hymn sheet. The deal is dead on arrival if America's own house is divided. 2, partner incentives. Other countries, like Japan and in Europe, have to actually want their currencies to get stronger, which is a tough sell when it can hurt your own exports. 3, a G7 language shift. The world's top economies would have to ditch their usual hands-off, let the market decide mantra. 4, it's got to be a grand bargain. It can't just be about currency. It has to be a bigger package deal on things like trade and interest rates. 5, you need a speed control plan, an exit strategy, just like the Louvre Accord, so the dollar slide doesn't turn into a chaotic freefall. And finally, number 6, the China factor. This is the huge new variable. Back in '85, China wasn't a major player. Today, it's the world's 2nd biggest economy. Any deal has to have a plan for how Beijing will react. For a new accord to even be on the table, analysts say at least 4 of these 6 boxes need to be checked. So the million-dollar question, or maybe trillion-dollar question, what are the actual odds of this happening? Well, analysts don't see it as a simple yes or no. Instead, they're looking at 2 very different ways this could play out. Think of it like this. On one side, you've got the full version. This is the big Hollywood blockbuster sequel, a true Plaza 2.0, with the US, Japan, and Europe all teaming up to slam the dollar's level down. The hurdle to pull that off is incredibly high. But then you have a much more plausible mini version. This would be more targeted, mainly between the US and Japan, and they'd use the existing G7 playbook, talking about curbing excessive volatility, as cover to put an unofficial ceiling on the dollar's strength. The hurdle for that? Much, much lower. And this chart really puts it all into perspective. Analysts are saying the chance of a full-blown Plaza-style sequel in the next year is only about 15%. Pretty low. But the odds of that smaller, mini version that just tries to cap the dollar's rise, that's a whole different story. They're putting that at 55%. So what this tells us is that we should be watching for a more limited, surgical strike, not some grand, sweeping declaration. Okay, so you're probably wondering, how will I know if one of these deals is actually getting close? What are the real-world signals we should be looking for? Well, I'm going to give you a 5-point insider's checklist of things to watch that would be a huge sign that the odds are shifting. First, keep a close eye on the official statements, the communiques that come out of G7 meetings. If the wording changes from just being about volatility to explicitly mentioning currency levels or imbalances, that is a massive red flag. Second, listen to the U.S. Treasury Secretary. If he or she starts complaining in public that the strong dollar is wrecking U.S. trade, that's a big tell. Third, watch for a pattern of warnings and something called rate checks. That's when central bankers start calling around to dealers. It's a subtle but very clear threat that they're about to step in. Fourth, listen for signals from Europe. They don't have to join the party, but they do have to signal they won't try to stop it. And finally, the ultimate trigger. If the strong dollar itself starts being talked about as a risk to America's own financial stability, well, then the motivation to act becomes enormous. So there you have it. We've got the historical blueprint from 1985, we've got the 6-ingredient recipe for what it would take to do it again today, and we've got the checklist of warning signs to watch for. All the conditions are known. The only question left is, will all the stars align? That's what we'll all be watching for.